As the second half ramps up, CIO's preferred asset class is for high-quality bonds. For investors seeking a steady stream of tax-free income and low probability of payment default, municipal bonds fit the bill. This is a conversation well worth your 10 minutes on UBS Trending. Hi everyone, and welcome to UBS Trending. I'm your host, Dan Cassidy. I'm joined today by Kathleen McNamara, Senior Municipal Bond Strategist from the UBS Chief Investment Office, to talk about the latest in the municipal bond space. Kathleen, it's great to have you back here at the table. Great to be with you today, and thank you for spending some time with our viewers.
Thanks so much for having me in, Dan.
So, Kathleen, let's get right into it. Before we talk about what the second half of 2023 has in store for muni investors, maybe we can talk about how we got to where we are today. So can you recap for us the municipal bond market performance on a year-to-date basis?
Sure, Dan, I'm happy to. I mean, in the first half of 2023, there was no shortage of external factors that produced headwinds for the muni market. We had a more hawkish Fed combating stubborn inflation. We had a regional banking crisis that prompted muni portfolio liquidations by financial institutions. And of course, the last-minute debt ceiling negotiations, right? Those all represented some pretty strong headwinds for the market. That said, munis prove resilient. As a point of reference, the yield on the muni index is now hovering around the 3.5% level, which is not too different from where it was in early January. But we witnessed a lot of volatility along the way, as you can see in my chart. On a total return basis, the tax-exempt muni sector did post some really good results through the first half, gaining about 3%. By comparison, an index of U.S. Treasury securities posted softer results over that same time frame.
Pretty strong performance despite those unexpected events and what was at times a turbulent first half of the year. So it's interesting. I'm thinking back, Kathleen, to 2022. As our viewers might recall, it was a fairly dismal year for return for fixed income investors. Yet here we are in 2023. The year has delivered better days thus far. So if we look ahead for the balance of the year, what are your performance expectations for munis?
In the near term, Dan, we do think that munis are apt to continue to benefit from a positive seasonal technical backdrop where reinvestment capital exceeds available supply. Therefore, valuations are apt to reach some of the tightest municipal to treasury yield ratios of the year before reversing course to some cheaper levels in the fall. Away from supply and demand dynamics, we do expect range-bound U.S. Treasury yields or even perhaps lower Treasury yields by the end of the year. That is positive for municipal performance. So putting that all together, barring an unanticipated sharp rise in Treasury yields, we think that municipal bonds can continue to deliver some solid returns between now and the end of the year for investors.
So Kathleen, I have to ask, important consideration with the muni yield curve inverted, how should muni investors be positioned?
That's right, Dan. I mean, the high-grade muni curve remains inverted, and that's an experience that has not occurred in the tax-exempt market before the end of last year. Against that backdrop, we do favor barbelled portfolios. You know, although positioning in cash, money market funds, and short-dated bonds have certainly become more appealing recently, we do believe that adding an allocation to longer-dated, high-quality municipal bonds is prudent. Why? We don't think that investors should wait until the last possible Fed rate hike to start looking for opportunities to lock in attractive yields. In fact, at the moment, we do recommend munis in the 12-year to 20-year range. If you look at my chart here, it actually shows that AA-rated taxable equivalent yields at the 20-year maturity point are actually much higher than they have been on average over the past 15 years. So to us, that suggests this is a good entry point for investors.
So it sounds quite compelling. With that, maybe we can get a bit more granular when it comes to positioning, talk about some muni sectors, and within the municipal market guide, you do highlight some portfolio themes on a monthly basis. So what are some considerations when it comes to themes that investors should be mindful of at the moment, Kathleen?
I mean, yes, Dan. I mean, infrastructure spending is a big theme our CIO team is now focused on. And municipal bonds is a good way to get exposure to these trends. As we wrote in our recent Made in America report, and we also threw a spotlight on the topic in our July edition of the Municipal Market Guide, as you point out, the municipal market certainly stands to benefit from a significant boost of federal funding for critical infrastructure from three key pieces of legislation. While the benefits of each infrastructure package, the Infrastructure Investment and Jobs Act, the Inflation Reduction Act, and the CHIPS Act will vary by muni sector, we do believe that there are three core areas of the municipal bond market that will stand to benefit from a credit quality standpoint. Transportation-related sectors, utilities, and state and local governments all make that list.
So quite a wide range of considerations out there when it comes to positioning.
Absolutely, Dan.
Well, Kathleen, thank you very much for dropping by UBS Trending and sharing with our viewers your latest thinking on the municipal bond market, how conditions might evolve through the second half of the year, and of course the considerations when it comes to positioning within. Great catching up with you as always.
Thanks for having me, Dan.
And thank you, our audience, for joining us on UBS Trending. For more information, be sure to visit ubs.com/views. Make sure to follow UBS on social media, LinkedIn, Facebook, Instagram, Twitter, and check out our past trending episodes on demand. And as always, if you have any questions about your portfolio, please speak with a financial advisor. Until next time, I'm Dan Cassidy. Have a great rest of the day, and remember to keep your eyes on what's trending.